For insurers like Allienz, financial instruments dominate the asset side of the balance sheet. The income we earn from these investments is crucial, both to the returns we offer customers and the profit we offer shareholders. The global financial crisis showed the reporting standards for financial instruments were too complex. Moreover, markets plunged in the crisis, but write-downs on the value of investments were generally considered too little, too late. To overcome these weaknesses, a new international accounting standard for financial instruments was developed, called IFRS 9. IFRS 9 is effective from 2018 on, but as an insurer, Allienz can benefit from a deferral and is allowed to apply IFRS 9 together with the new international accounting standard for insurance contracts, IFRS 17, for our group financial statements in 2021. IFRS 9 introduces two major changes to investment accounting. First, a more logical and principles-based approach to classify and measure financial assets, which brings more transparency. Second, an expected credit loss model which is more dynamic and forward-looking. In general, measurement categories remain similar under IFRS 9. Only the logic of when they apply changes. Let's look in more detail how we will classify and measure our investments. To begin, we need to make a distinction between debt and equity instruments. Equity instruments, such as stocks, will always be measured at fair value. Management may opt to present changes in fair value either in the profit and loss account. Management also has the choice to present changes in other comprehensive income within equity, without realizing any gains and losses in the profit and loss account. Less than 10% of our financial instruments in scope are equity instruments, and over 90% are debt instruments, especially in the form of bonds and loans. So let's focus on debt. For the classification of debt instruments, we need to walk through a two-step approach, which will result in the determination of the measurement category. First, we have to look whether the debt instrument, for example a bond, qualifies as simple debt. Simple debt means we solely receive interest in repayment of the amount outstanding. If the instrument qualifies as simple debt, we then have to look in a second step which business model applies. As an insurer, holding our investments to collect contractual cash flows and selling our investments are both core components of our business model. Therefore, we have defined hold and sell as our predominant business model at Allienz. The hold and sell model allows us to account for simple debt at fair value, with changes in fair value presented within shareholders' equity. This lets us avoid the volatility that would arise if changes in fair value went to our income statement. If the debt instrument does not meet the simple debt definition, it will be measured at fair value through the profit and loss account. An example of a critical bond is a bond that is convertible into equity instruments of the issuer. Fair value changes of a critical bond are presented directly in the profit and loss account, which has the potential to make our profit and loss account more volatile. The second key change resulting from IFRS 9 is that for simple debt, we will be required to estimate and proactively recognize expected credit losses. Under the current regulation, we only recognize actual credit losses when they are incurred. Under IFRS 9, expected credit losses will be based on the risk that we will not be paid as much as we expect or in the timeline we expect. As a result, Allienz will need to look out for significant deterioration in the credit quality of our investments based on rating downgrades at each reporting date. As long as the investment is performing as expected at purchase date, we have to look for a loss from a loss event within the next 12 months. If the investment is not performing as expected, we need to look out for a loss from a loss event at any point within the lifetime of the investment. A longer time horizon significantly increases the amount of expected credit loss in line with the increasing uncertainty associated with a longer time horizon. Compared to the current impairment model, the introduction of expected credit losses under IFRS 9 will present a more transparent and realistic view of the credit quality of our investments, based on the most up-to-date expectations at any given reporting date. Let's sum it up. IFRS 9 brings greater transparency, and with its forward-looking impairment approach, a more realistic view to our financial statements. Both help us better demonstrate Allianz's financial strength to our stakeholders.